Coming at you live from Brooklyn and Jersey, it's Real Talk, Rates, and Repeat with your hosts Gary and Queenie from Cliffco Mortgage. Real stories, real advice, no fluff. Let's go.
Welcome to Real Talk, Rates, and Repeat, the podcast where mortgage means mindset and real estate gets real. We're your hosts, Gary and Queenie, are two mortgage bankers with a lot to say and even more to uncover. Let's talk shop, let's spill some secrets, and let's repeat the stuff that really matters.
What's that other big topic that everyone hears? And honestly, when I started hearing this, I thought I was in some sort of like crime or legal novel or whatnot. The feds. The feds. Everyone's like, what are the feds doing? The feds doing this, right? And it's like, I want to take this chance to kind of clear up that the feds, the Federal Reserve, does not determine what the interest rate is, period. It plays a very big part in what the actual mortgage rate is, but the feds, they don't set the mortgage rates directly. But it controls something called the federal fund rate, which is the rate banks charge each other overnight. So that has actually nothing to do with what the bank is charging you as a buyer for interest. So when the feds are raising or lowering rates, it affects how the banks are being charged. But the actual rate that you are getting as a buyer it has nothing to do with that. So you hear, oh, the feds are reducing rates by 0.5%, and all of a sudden you think, oh, so my 6.5 is going to go to 6%. It's actually not. So that's a huge topic, because I think that's like the first thing people Google, actually, aside, or maybe the second thing, aside from, what is the current mortgage rate? They'll Google, like, what are the feds doing with rates? Are the feds lowering rates? When are the feds lowering rates, right? But that's, I just want to kind of clarify that's not your direct mortgage rate.
No, I think you hit it right on the head. I mean, that's going back to what I was saying, is just really facts and myths and things like that. I mean, that's a huge misconception that people don't understand, is whenever they do say, oh, the Fed is going to lower their interest rate. It's like you said, it's basically, it's just a borrowing rate between bank to bank. That's all it is. It doesn't really impact sort of long-term mortgage rates. But what does it impact, right? It'll impact your car notes, right? It impacts your home equity lines of credit, and it impacts your credit cards. Those are the major things that it impacts, which people don't understand. So what do you think are some good websites for people to take a look at, just for educational purposes, not to price out their loans, but to, let's say, just track?
Honestly, I really don't know, though, Gary. I don't know the answer to that question. What is a good website that you have found reliable, or to an extent?
So to an extent, I do let them know. It's usually just for sort of like loan originators, but I always tell them, go to Mortgage News Daily. It'll tell you sort of, anything sort of impacting the mortgage industry, and it'll give you a pretty good charts as far as where rates are going. It does give you a national average, but it also gives you something what's called the Freddie Mac mortgage rates, which those are not the rates that that are published for Freddie, but those are the rates that Freddie sort of publishes for banks, because those are bank borrowing costs for the bank. So that is a website that I generally tell people to go and look at. It is a free website. We obviously get no compensation for mentioning that site from Mortgage News Daily. So I
We
mean,
should reach out to them for a little for some acknowledgement. But no, you're right. That is true. And what you had mentioned earlier in the episode, where you said, we kind of do trail the 10-year treasury yield, right? So to some of my more informed buyers, I would tell them, go ahead and kind of track that, but what you're tracking is the flow of it
Movement.
versus the number. Yeah. Like if you're seeing this certain movement, then okay, maybe the rates will be trending in a certain direction. So I would educate them in that sense. Don't track it in the sense where you have to know the exact, what is the yield and how that translates into a mortgage rate, because again, it's not going to translate directly into your mortgage rate, but the trend and the pattern of the movement is what's going to tell you, okay, are the rates going up or down?
Well, so like I said, mortgage rates will follow the typical movement of how the 10-year is tracking, and really that's what you're doing, is just tracking the movement. So if you see significant volatile sort of news in the market, and you see the 10 years going up, that means rates are probably going to go up. If they drop significantly, that means rates might drop. And usually when do we see large term movements is whenever there is significant, I would say, economic data that was being released, or significant world events happening, right? Like we saw COVID. COVID was a perfect example, obviously, and inflation, everything was put on hold. There was a lot of uncertainty, so 10-year dropped out, right? Inflation came back and rates started to jump up, right? What other recent thing did happen that rates dropped? So I would say something that impacts significantly, almost monthly, is the jobs reports, right? That's a major indicator of how well the economy is doing. That impacts sort of where rates are going. Payroll data. Yeah. What else do you tell your clients?
That's pretty much, bulk of it, right? Because once you start diving into all that, they're like, "Ugh," like 90% of the buyers will not be tracking the
They're not.
all of
Yeah.
the factors that you put out, you just named, right? Because
Mhm.
it's a lot. Then now you're kind of doing the job of like even our ops team, when it comes to rates. But to, the 10-year treasury yield is the biggest item that I put out there, because that's one of all. For one, I'm leading them in a direction where you're really just looking at a chart, right? So if you're seeing this, the rates are going to go up. If you're seeing this, rates are going to go down, right? And to explain it, it's kind of like, both are between the 10-year treasury yields and mortgage rates. They're both long-term investments that are relatively pretty low risk, right? So when investor demands higher returns than like on these
Doesn't look
bonds
good.
and these mortgage notes, then mortgage rates are going to rise. So it's pretty much just, even without understanding what any of that means, you look at the chart, you Google 10-year treasury yields, you can look at it every single day if you want to. And if you're seeing it trending in one direction, that's the direction the rates are heading, right? But again, it's a pattern. Don't look at the number, literally just look at the line, right? And you will see the trends. And that's when you're kind of like, oh, if you see like a big dip, feel free to give your loan officer a call and say, hey, like I've noticed this. Does that mean anything for my rate, or will it do anything to my rate? And open that line of communication. Because I have clients, I do tell my clients, hey, look, if you want to text me every day and say, where are the rates today? Totally fine. I will respond to you and I will tell you what the rate is for
Yes.
your specific file. But if you don't want to do that, and you're someone who's like, hey, look, I don't want to text you or call you every day, what do I do? Look at that chart, look at that pattern. And when you see like actual movement and you're curious what that movement translates to in terms of for your specific case, then give me a call and it's completely fine as well. Right?
Yeah. Yeah, I do want to also sort of clarify that the 10-year is something that we generally follow, or is recommended to follow, for traditional financing on what's called agency loan sizes. So for those people buying, multi-million-dollar mansions and they're financing $1 to $2 million, that does not follow the 10-year treasury, that follows whatever the bank's sort of internal sort of profit margins and analytics are. That does not follow the 10-year. I just want to clarify that.
That is actually a really good point, because that that's another very hard conversation I've found myself having to explain to my clients, because there are then as well those clients again who would go and Google or look online and see this is the movement, these are the trends. They didn't even need me to tell them all this. But then they forget, hey, this only applies to a certain group of mortgages. And then what about if you were, like you were saying, Gary, the jumbo loans, the portfolio loans that the bank is holding themselves because the loan sizes are too big, or there's something about the file or the deal in specific that they can't sell back, right, to Fannie Mae or Freddie. Then yeah, the bank actually has more of a say as to how they're going to price out these type of, I don't want to call them higher risk loans, but portfolio loans that they're going to hold themselves, because then they actually have the flexibility and the right actually to price them differently and have certain add-ons to the price that they deem is necessary in order to keep these types of loans in-house. And you're in New Jersey, I'm in New York, but we do all different states, mortgages in all different states, right? But the truth of the matter is, in New York and New Jersey, we're into the states where real estate is expensive. So we do deal with a lot of higher priced properties where their loan may not be agency and it is portfolio. So yes, definitely give us a little bit of that grace, like to understand, hey, it's not always just what you see online, and trust that when we're explaining to you, hey, this is how we're coming to the rate that we're giving you, there's real logic behind it. We didn't just make it up or decide like, hey, I'm going to give you this rate because I like you or I don't like you, right? So yeah. But the one takeaway from this specific episode, basically, when you see news about inflation or a Fed rate hike, yep, it could mean that there's going to be a little bit of a ripple in your mortgage rate. It may go up. But again, most importantly, go back to your loan officer, speak to them, talk to them about what you're thinking, what you're seeing. Fact check through your loan officer instead of trying to fact check yourself. It's just, it's easier that way. And then until next time, me throw a new crazy topic at you guys.
Well, thanks for tuning in, guys. We will see you at your next episode. And for our contact information, just stay tuned. It's in the end.